and welcome back to the all new Blueprint strategy course, and welcome back to a new module, module 4, market timing. Now, I spent a lot of time asking myself how to best approach this module, because this module should only be applied in the overall context of everything that we have done to date. So it becomes a bit tricky on how we're going to approach this topic. So what I'm planning to do is cover a bit of theory, jump into charts, cover what we've covered already, get in a refresher, and then apply what we're newly going to add on to our strategy, which is going to be the so-called zone qualifiers. Now, zone qualifiers are just going to be rules that we're going to apply on our supply and demand zones that we find on the lower time frames. So far, we just spent a lot of time on the higher time frames. Now we're going to drill down into the lower time frames. And for the lower time frames, the supply and demand zones will have additional rules. These rules are called zone qualifiers. They're also going to be mechanic. They're going to be simple. They're going to be objective. And they just help us additionally to pinpoint these supply and demand zones a bit better. So here you can see all the different rules that we're going to cover, not all of them today. We're going to take our time on these. We're going to start with departure and base duration, which is the zone structure. We're going to talk about freshness versus originality, which is the zone nature. And we're going to talk about profit margin as well as arrival. Lastly, we're going to talk about level on top of level, which is almost an additional step of the process. So we can spend a lot of time on level on top of level as well. And then, of course, trade management, know when to hold them or when to fold them. And this is going to be also a complex lesson that we will spend some time on as well. So without much further ado, let's just jump straight into our slides and then also into the practical application bits on market timing, as well as all the other things that we've covered so far, all the other rules. So this slide should be familiar to you guys. We use different timeframes to analyze price. And so what we know is that the higher timeframes are powerful for understanding the bigger picture context. And we use that to increase our probability of success. That's going to be a KPI in form of the win-loss ratio. And the lower timeframes are going to be powerful for market timing. Market timing we're going to use to optimize our profitability. In other words, the KPI that we attach to that is going to be risk to reward. The most important thing that I can teach you today is that the lower time frame should ideally be within the right context of the higher time frame analysis, both technicals as well as the fundamentals. I have seen lower time frame zones that are textbook beautiful, that meet all the rules, that fail. And I've seen lower time frame zones that just work regardless on the rules that you would apply on that. They're just ugly lower time frame supply zones and demand zones, and they would just work. So we've got good zones, or zones that meet the rules that would work, and we've got bad zones, zones that don't meet the rules that don't work. More often than not, what is going to be the case that the ones that are least likely to work are the ones that are outside of the overall context of the higher time frame analysis, both the location as well as the direction analysis and the fundamentals that you're going to stack on top of that as a layer, as an additional layer. So zone qualifiers are just going to be rules. And these rules, they allow us to identify and further pinpoint institutional trading activities. So these areas of supply and demand, the lower we go in terms of the time frame, the more supply and demand areas we're going to find within our charts. So we need to have a way of arguing quality versus quantity when it comes to our supply and demand zones. And so these zone qualifiers, they will help us to argue and to qualify buying and selling zones to ensure that we've got these high probability setups, right? We want to ensure a low risk, high reward, and high probability trade setup. And these zone qualifier rules, they will just help us to do that. So it's always going to be about optimizing KPIs, right? So we already mentioned that the higher time frame analysis, the location and the direction was always all about the win to loss ratio. If we have a better understanding of the bigger context trends and the bigger context supply and demand zones, the weeklies and the monthlies, then we have the odds in our favor if we take a trade, to take the trade into the right trajectory of future price. However, there's going to be multiple ways on how we then can place our entries, our stop losses. We could, of course, always place our entries and stop losses and targets on the higher time frame. In that case, we would always struggle to find quality risk to reward trade setups or trade propositions. Now, we need to have both. We need to have a quality win to loss ratio, which is just going to be about 40-60. So we're actually going to be wrong more often than we're right. And in combination with a risk to reward ratio of 1:2, that will allow us to be consistently profitable over time. And to achieve at least a 1:2, we have to operate on lower time frames. There's just no other way around it. So the lower time frames we don't use because the lower time frames are stronger than the higher time frames, right? No, we use the lower time frames as a means to optimize our risk to reward ratio, to place better entries, to place safer stop losses, and to therefore have better targets and then overall have a better risk to reward ratio. So the lower time frames will help us to do that. And so all of our rules, or all of the rules that I'll now introduce, they'll be objective, they'll be mechanical, they'll be simple, they'll be rule-based. And that's the only way for you to be consistent in the market, if the rules that I'm going to introduce meet all of this criteria. But remember that the why on the lower time frame is always, you have to remember, okay, I know what I want to do based on the higher time frame, but I need to have a way of timing this entry stop loss target that allows me to have a solid risk to reward ratio, that if I get this right, that I don't just make a 1:1, I may have a 1:2 or a 1:3 or even more on the table. That will then allow me to be wrong more often than I'm right, because whenever I'm right, I make a lot of dough. So these are going to be the zone qualifiers, all 6 of them, and there's going to be more. So there's going to be the level on top of level, which I have not added here because I see it as a separate step in the process. And those 6 zone qualifiers that you see here, they're kind of intertwined with one another. They work together almost. And we can categorize them into 3 different categories of qualifiers. We have the structure of the zone, which is going to be the departure and the base duration. So we're going to look at the different legs of the formation, the different parts of our formation. So we're going to look at the leg out as well as the base for that, which are important parts of our formations. Then we've got the zone nature. Here we're going to look at freshness as well as originality. Freshness should already be a term that's familiar to you. We covered this on the higher time frame. Now on the lower time frame, we need to cover this again a little bit more scientifically, because as we go lower in terms of the time frame, the more scientific we have to become. And so the rule is going to change slightly when we talk about freshness on the lower time frame versus when we talked about freshness on the higher time frame. Originality is going to be a concept that I introduce where we don't look to the right to check freshness. We're going to look to the left of the zone to see where the origin of that potential move came from, or whether the zone that we're looking at is potentially the origin. Now, that's going to be a complex concept that we may have to spend some more time on, but I'll try to make it really simple. The good thing is that throughout my years of also mentoring and seeing other people do well and don't do well, I kind of know where people struggle and what we may need to focus on a little bit more. So that's also what I'm going to do in these lessons, is I'm going to focus on the points, especially where I have the experience that people usually lack some exposure or skill on. Then lastly, we have the zone location. And here we're just going to look at profit margin and arrival. And for example, departure and profit margin will be two rules that are kind of intertwined with one another. They interplay. So if we have a zone with a good departure, usually we have a good profit margin as well. And base duration as well as freshness, they kind of interplay with one another as well. If the base is weak or messy, then usually the zone, is also could not be fresh also, or we have a freshness problem there. So you can see these rules, they will interplay with one another. We have to look at the bigger context of these rules and why we apply those rules. And what I never want to do is I never want to isolate one single rule over everything else that we have done so far, right? There will not be a single rule that I can tell you that will overrule everything else, right? What we're looking at is a complex market, an imperfect market, and there's not going to be one single rule that I can tell you that, oh, now I've looked at departure and the departure is not quality, so I'm going to throw out the entire analysis that I've done, right? That's not how it works, how it should work. But in the beginning, of course, we have to be more black and white. In the future, we're going to move towards more gray. You can only move towards more gray if you have a lot of sample size of trades and if you gain experience in the market as well. So you really see what works and what doesn't, also for yourself and not just me preaching about certain subjects here. So all of these in the beginning, when you take a trade, all of these rules that I'm now going to introduce, they should ideally be met for you to take a trade. The more rules you have, the more stricter you are. The good thing about that is that the less trading opportunities you will find, which in the beginning is oftentimes good because it takes the heat out of the market, right? Because you're really focusing on rare, high quality setups. Now, I'm going to always tell you which ones you should put more focus on versus which ones you should put less focus on. Okay, so there are more important rules versus less important rules. So I would say straight from the get-go, something that's going to be extremely important most of the time is going to be the departure. If we find a good departure, hey, that's a really, really important rule. What's kind of less important is the base duration. Okay. Here, what's kind of less important is the arrival. What's a lot more important is going to be the profit margin. And so the profit margin as well as the departure these are two really important rules. And the freshness can be important too. And originality, I would categorize also as less important, but oftentimes it does matter when we look at it. So all of these rules, they will help you to identify and pinpoint further when you go into lower time frames, right? Because if we do go into lower time frames, it is going to be essential that we have a very scientific approach. And so the lower you go in terms of timeframes, the more scientific you have to become. The higher you go in terms of timeframes, right? On the highest timeframe monthly chart, it's like, okay, everything that looks like a level is a level, because, you know, who can move these charts within monthly timeframes? Only the big guys. So we know, okay, regardless of the structure or the nature or the location of our monthly zones, they're gonna be strong most likely. When we look at a 60-minute time frame, things are going to be very different. So the lower we go, the more scientific we have to become. Hence, we are adding 6 new rules, even more than that. And then I'll show you along the way which ones we kind of should really focus on and which ones it's good to look at, but we don't necessarily have to do this all the time. If all the other rules are met, then we're not just going to have because of one rule not being met, we're not just going to throw everything overboard, all the other 10 steps that we've done before, right? If we've done 9 steps and it's all good, and then we look at base duration and we're like, hey, okay, base duration doesn't meet the rules, so we're not just going to throw the trade overboard. Okay, there's always going to be that sensible discussion, that internal discussion with yourself, where you're going to say, well, are you kind of slightly bending the rules, or are you completely breaking the rules? So where I don't want you to bend the rules is when it comes to the higher time frame, location and direction. There we don't bend the rules, right? And fundamentals are fundamentals. It's very objective. We don't bend the rules. When it comes to market timing on the lower time frame, you will be allowed to bend the rules. You will be allowed to find your way in the market, and your style of market timing is going to be very subjective. So I cannot sit here and say this is going to be a 100% objective approach, because it can't be. We're now talking about placing entries, placing stops, and placing targets. That this cannot be a completely objective analysis, because depending on what you see, you may want to get into this market really aggressively, or you may want to get into the market really conservatively. You may want to use price action rules. You may want to use supply and demand. You may want to use 240-minute. You may want to use 60-minute. You may do a weekly income. You may do a daily income. And depending on also your trading characteristics, how risk averse you are, for example, your market timing is going to change significantly. Okay, your zones may look, you may trade different zones than I do. Okay, and I see that on a daily basis. And this is also an important understanding from the get-go, that you understand this, that when it comes to market timing, there's going to be subjectivity and a lot of gray, which in the beginning I'm trying to rule out, but I'm also, because this is an all-encompassing strategy course, I'm also trying to, give you a glimpse of the future, where this is going to go, because we're not always all going to trade exactly the same zones at the same time, right? It's just not how it works. If it was like that, we would always have, all of us always would have exactly the same trades at the same time. And I just never, ever see that, right? You just have to look at Toby, myself, Clemens, and Bernd. And then I can talk about Jan here in the room as well. And Bash, I don't know that well, but I know Jan very well from the mentoring. I now have 5 traders, and we all in the past week probably took different trades. And so if you come to the understanding here, you also come to the understanding that, okay, I have to apply this, right? And I have to be black and white, but I also have to apply this with an understanding of who you are going to be as a trader, and who you are as a person as well. All right, so now without all of that out of the way, let's just jump into the first zone qualifier. The first rule, which is going to be departure. Now, when we look at departure, we're going to look at the leg out of our formation, whether that's a demand formation, whether that's a supply formation, whether that's a drop-based rally or rally-based rally, whether those are the U-shapes or the drop-based drops, it really doesn't matter. We're always going to just look at the leg out of the formation. And what we want to see is that the leg out is made of explosive candles, ideally. Okay, so you have now two examples here that are drawn. On the one, you have a clear explosive candle. And on the two, you don't have an explosive candle, but you have a large candle and you have follow through. So if I now had to rate this, right, and I had to objectively say which one is better, then of course one would be better, because in the one example, I have a lot less selling pressure and just a lot more control of the buyers pushing this higher without even sellers coming into play. But if I look at two, there were some selling pressure that came in, and then eventually the buyers pushed this higher and the origin is down here at the base. However, I can see that the buyers here were more in control of price than they were here overall. Objectively arguing this, we would have to say that one is better than two. However, two is also good, right? Because the buyers were clearly in control. And depending on what time frames you're gonna have here. So for example, if let's say if both of them are the same time frames, if both of them are 60 minutes, then we can clearly say that this here is better than this. But if this was a 60-minute and this was a 15-minute, then maybe if I'm going to change this chart to a 60-minute chart, I will get exactly the same explosive candles than what I don't see on the 15-minute. So it's also going to be a conversation about, okay, what's the time frames that I'm looking at? Because if I see two decisive but not explosive candles on, let's say, a 15-minute chart, if I put this into a 60-minute, I may see just one very explosive candle, right? So I cannot upfront say this is worse than this. In theory, it is if we were looking at apples and apples, the same time frames. However, both of those scenarios, for all the reasons just mentioned, are going to be fine. What's most important is, rather than meeting the explosive ratio rule of the candle, what's going to be a lot more important for me is that the size of the candle overall, right? The size of the candle overall is abnormally bigger. So there's going to be two rules that we will apply here. There's going to be that the leg out has to be made of an explosive candle, and or the alternative rule here is that the leg out can also be a decisive candle if the candle is also abnormally bigger and it's got follow through. Okay, it's followed by another green candle. If here we had just a red candle from the get-go to the downside, then this is something that I wouldn't consider as per the rules. But if we have an abnormally big candle with follow through, that's also as per the rules on the lower time frame. So this is our new lower time frame rule. Okay, as we spend time on the higher time frame, just for you to see the difference, as we spend time on the higher time frame, we just needed decisive candles, right? And we even had that alternative rule that everything that looks like a level is a level. So the difference here on the rules is quite extreme, and this is where you can see, okay, we go lower in terms of time frame. So what has to happen? We have to become more scientific. We have to become more strict with our set of rules, and that's just naturally what's going to happen also with freshness, and that's why we add on multiple layers of additional rules like base duration or originality on top of that. So why do we look at the move out? Well, it's quite clear, right? A stronger move out of a zone just implies a bigger imbalance of a supply and demand zone. That's just how it is, right? And so here's just some examples of what we're always going to ask ourselves is, how did price leave the zone? Okay, so now if we look at supply, of course, we're going to look at red candles. So we have a really good move out here, explosive, just red candles follow through. That is a strong move. That's great. Likewise, the same could be true for demand. So when we look at demand, of course, the leg out is going to be green candles. That would be very strong. Just the inverse. What's acceptable is here just lots of decisive candles, but they're kind of normally bigger and it's overall a large move. And as well on the demand side too. What's going to be weak is right this. This is not going to be acceptable. Just, you could also call this staircasing, stepping. This is not going to be acceptable on either side. And so what I want you to think of these moves, almost I want you to think of them as one, right? So if you are on a, let's say a 240-minute time frame, and you're going to see 3 candles in your leg out, of course, I mean, the rules will tell you, well, start at current price, look up, just going to look at this candle and then look at this candle. And if this candle is explosive, you can take it. Yes, fine, right? But what I would rather you do is find the leg out, and then in finding the leg out, also look at the overall move of the entire structure, because the departure is part of the zone structure. So I really want to see the structure and analyze and define the structure, the entire structure of the zone, not just isolating one candle, but seeing, excuse me, the overall structure of it. Similarly here, we would not just look at this one candle, we would look at the entire structure of the leg out, which would imply and include all of these candles right there. For the demand, this candle would be enough, but I'm going to look also at the entire structure of the leg out. How much follow through is there going to be? So there's going to be an interplay with profit margin, which is going to be an additional rule that we'll talk about here. So here will be some examples, but rather than making examples here, I just want to go into the charts with you guys as promised. And what I want to do in the process is I now want to start working my way from the top to the bottom. So we're going to try and talk about as many markets as we can, starting with the top on the equity indices, because I see some market setting up. Now, what was the first lesson, or the first, or the most important teaching point of today is we have all these steps of our process, right? We have the higher time frame on the weekly, 2 charts, which is one for direction, one for location. Then we have a lower time frame chart on the daily. Now, if we're doing weekly income. So what I cannot do is I cannot start on the daily and then work backwards. Okay, I have to start on the higher time frame and then ensure that once I go to the lower time frame, I make sure that the lower time frame is within the right context of my location analysis, of my direction analysis, of my indicators here, and of my indicators here. So whatever zones I'm going to draw here, and whichever one I'm going to take, I could take supply, I could take demand. This will depend on what is the location, what is the direction, what is the fundamental fundamentals in terms of the COT or the valuation or the seasonality, right? And all of these steps will then flow into the decision matrix of whether you're going to trade this or whether you're going to trade this. Okay, so for me, there's no way of covering now this analysis without covering the previous steps before that. And also, while I'm doing that, I think it's also going to be helpful for some of you because it is an all-encompassing strategy course. So rather than looking at these rules isolated that I'm now going to introduce, we have to look at these rules in the right context of everything else that we have done to date. And so everything that I'm doing now shouldn't be anything new to you guys. These are steps that we have done from day one. So I'm also not going to write them down. I may write a few things down when it comes to the lower time frame, to new rules, but all the old rules, all the steps before, they should now be steps that you should have already written down and potentially practiced as well. So starting on the weekly time frame on the Dow Jones, doing a weekly analysis and weekly income for the Dow. Now on the Dow, I could use two different charts. I could use the @YM equals 107 XN, and or I could just use @YM for the equity indices. You can note down that most of the time it doesn't make a huge difference. What was it? 103 XN. I know that Burn, for example, uses a lot of times just the @YM. They are very much. I did this wrong. @YM equals 107 XN. They're very similar, and so regardless of what you use, you can stick to that. I just like the @YM equals 107 XN, which is the unadjusted continuous contract, the custom unadjusted continuous contract for the Dow Jones. But if you just have access to @YM, you will notice as you do the analysis parallel to me, it's going to be more or less the same, especially on the recent supply and demand zones. It may be slightly different as we go further out into time. There it may be slightly different. So weekly analysis, weekly location, I'm just going to look for demand as well as supply. So what I'm going to do for demand, this is a weekly candle close. So in this case, I could start with this weekly candle right here and determine whether that's a decisive candle or not, whether that's a large green candle or not. It could be, if this was a large green candle, then I could say I have some demand somewhere here. And if I wouldn't see that, I would for sure see this demand down here, right? Because then it would be this green candle that's really jumping into my eyes. And so now we could argue, well, which ones should we use? The short answer is use the first one that's as per your rules. If you're uncomfortable with this zone, don't use it. If you are comfortable with this zone, if you see kind of, okay, I have a drop, then I have a base, I have a rally, then that's also fine for you to use. In the beginning, though, if you wouldn't see that, then it's also something that you wouldn't have to take. You can just go down here and put this in, and then that may skew your location frame a little bit, but better safe than sorry. Now I'm going to look at supply, and I want to find some decisive candles. So the issue with supply now is that I will have to look extremely high up to find some explosive and decisive candles. Here is the first one that I see that if I put in the level, that's also going to be fresh, right? So freshness on the higher time frame, we have the 25% rule. And both of these are fresh because price hasn't been in here in those levels so far. So I'm going to divide this now into 33 and 66. And now I have my different location areas from very low to equilibrium to high to very high. So we're at the moment still in the low. The lower we go, the more we want to buy, right? The higher we go, the more we want to sell. Not necessarily, depends on the trend as well, but just looking at this isolated, the higher we go, of course, the more we want to sell. The lower we go, the more we want to buy. So at the moment, we're still within low, almost very low. So already I could say, well, any sort of pullbacks potentially into the very low area, I would want to buy. And what speaks for that as well, already looking at the higher time frame, is that if we move higher, there's just not going to be any supply, opposing supply. There's just going to be lots of resistance in the way, which means that if we go higher, we could just have an absolute bang of a move up. So that speaks for that. It's also something that you always want to consider when you look at location. Is the advanced way is location, yes, is fine, but how much space to the upside to the next opposing level is there going to be? In other words, on location, you can already get an idea of how much potential profit margin you have if you maxed out the trade, which almost never happens that you max out a trade, but it's going to help and it's going to ease the way how price is going to move into your target. So already a lot of context you can get here just from the location analysis itself. So just by looking at location isolated, it's quite clear. At the moment, we want to buy. The lower price goes, the more we want to buy. So we also are going to do trend just quickly. And for that, I'm, of course, just going to add the zigzag. I don't like what I see, so I'm just going to change maybe the percentage points here a little bit. Why is he not taking? Okay, not sure why it doesn't actually read this low here. So, okay, that goes down the drain. So let's just do it ourselves quickly. Okay, so how many pivot points do we need? Roughly 6 to determine a trend. So we've got 1, 2, 3, 4, 5, 6. Let's do 8. My first conclusion here would be that it's a sideways trend, right? Already looking at this, I would say, well, this is going to be sideways. On another look, I would say we came from, so now we're looking at the bell curve, right? We came from a downtrend. Then we cleared out one of those prior highs. And then now price is basing in a sideways trend. So if you're now looking at this, and this is now part of the all-encompassing strategy course as well, right? I don't know how advanced you are, but if you're familiar with also price action and formations, trend formations in terms of trend structures, then this is the time where you're also going to check for trend lines, for trend structures, and all of the good stuff, right? So for example, you could put a trend line here And then you would kind of say, well, I've got a trend line maybe here, maybe I have a test here, and then I can see that this trend line, which was resistance, is now kind of support. What you can also do is, well, for sure, we have some sort of maybe a trend structure here where maybe we had a channel down that's now being broken out. But more important than all of that is what I see. I think the best trend formation that I see are two things here. One is the potential inverse head and shoulders that we're seeing with the left shoulder, the right shoulder, and the head. And my neckline being somewhere here. And that would imply for me, right? What would this imply? This would imply that I've got from this trend structure point of view as well, I've got a higher low as well as another higher low. So I've got two higher lows. If I was to remove this pivot point here, then I would have two higher lows. If I keep this pivot point, then I have an inverse head and shoulders, which is telling me the same. It's telling me anticipate a potential up move, a potential uptrend. So I could argue this is an uptrend, which is something that I would lean towards to argue now, okay, this is a confirmed uptrend because we have two higher lows here with one higher low and a second higher low. This confirms my uptrend. But you could also say, in terms of trend structures and trend formations, that this is a head and shoulders, and the head and shoulders would imply that we see a breakout. And if we see a breakout, then we're gonna, get a very high move here in terms of the technicals would then tell you the size of this is gonna come here, and then we would go into the all-time highs, which is very much possible here on the Dow Jones. So if you're not familiar with trend formations and trend structures, you can go ahead and watch the price action course that's also within the classroom. And just note down here that when you cover a trend, that's the place where you also want to just quickly, after you've covered trend, you just quickly want to cover your trend formations as well. I think with just doing trend, you can come to the same conclusion that, okay, this is an uptrend, but the inverse head and shoulders here is adding a lot of, I would say, probability for this being, and especially if we break out here, for this being either a future uptrend or already an uptrend. So the conclusion is for me the same. It just means that I want to be a buyer, right? So I want to be a buyer. I don't want to sell. If I was to sell, then, there's just a lot of pivot points, which means there's just a lot of resistance. And if I want to buy, where am I going to buy? I'm going to buy within the demand zone or within low, which I'm also allowed to buy within low. So now we can look to go into our lower time frame, which is going to be quality, right? Because now we can say, well, what do I want to do? Well, location told me I want to do what? I want to buy. So I don't even care about looking at supply. I just want to look at demand for now. What does trend tell me? Well, trend tells me I want to buy as well. So now I've got the step 1 and the step 2 aligned on the higher time frame. They both speak the same language. Now the question just becomes, where do I want to sell? Are the fundamentals also bullish? And when do I want to sell? Okay, where, when, and do we also have a fundamental setup in terms of, can we expect a major rally or decline also based on fundamentals? So there's a couple of steps left. In terms of where do I want to buy, already I know that we're within low. Ideally, I buy within very low. I don't have to. I can sell within low. So what I'm going to do is, within low, So the 34,000 mark, 34,000 point mark, what I can do now is I'm going to use the location to get to transfer that into the lower time frame chart. So 34,000 here. The lower boundary is going to be the 32,620, which is right around here. So now, in terms of demand, I've got a window of opportunity that's within the right context of both the location and the direction analysis. Okay, let me repeat. Now I've got a window of opportunity in terms of where, in terms of price, that's aligned within the right context of both the higher time frame location and direction analysis. So this window of opportunity now, what we're going to do here is we want to buy, and as simple as looking for demand zones on the higher time frame, we also are looking for demand zones on the lower time frame. So the steps in terms of how we're going to approach these zones, they're going to be exactly the same. Only the rules that we will put on top of our zones that will have to be met are going to be more strict, as we're now talking about the lower time frame. If we're speaking about daily, okay, anything where you have the dot before the time frame, so dot W, dot M, dot D. These are the time frames where you have to be less strict on. Okay, whenever you have a M after your time frame, so 240 minutes, whenever you're within the minutes realm, you're gonna have to be a lot more strict on your sets of rules. Okay, so on the dot daily, it can be considered even a higher time frame if you apply a daily income, right? So it has to make sense that on the way how you approach these rules, also in terms of the flexibility, how strict or vague these rules are. On the daily, you can be strict, but you don't have to. All right, so now I've got my window of opportunity. I'm gonna start at current price. I'm gonna look below before, and then just find an explosive candle. And of course, explosive candle right here, the first candle. Now, the only way I'm allowed to take the first candle is if the candle is closed. So we're doing this on the weekend, on a Saturday. So our candles, both the weeklies as well as the dailies, are gonna be closed. If this daily candle was running, I would not be allowed to take this as a leg out, because I don't know where this is going to close, right? Maybe we're going to close down here somewhere, which then in the case, this would not be an explosive leg out. But here, this is very much explosive. Now, all I have to do is find kind of the base here. And I would say the base is somewhere here. Now, there's going to be some ways on how you can draw this. Let me put a few ways in. Some of you may say that we have a rally and a rally, and that we have 3 basing candles in the middle. In this case, you would have a rally-based rally that looks like this, okay? Some of you may say we have a drop-based rally, okay? So a drop-based rally. In this case, you would put your candle, your proximal, probably here. Now, what I like better than the other, both are right as per the rules, depending on what you see. However, which one I like better is this one. Why do I like this one better? Well, I like this one better because automatically, while my distal stays the same, my proximal is gonna come down, and my proximal is going to be the entry. So I have a better entry. With having a better entry and the same distal that we're gonna use as a stop loss, we're gonna have a smaller zone. If we're gonna have a smaller zone, I'm going to have more profit potential. I'm going to have a better risk to reward on the way up. So just from a profitability point of view and optimizing our KPI risk to reward, I like this one a lot better. So my rule of thumb here is, and I may have mentioned this rule of thumb before, is that if you are going to look at your leg out, and in this case, your leg out is going to be this candle and it's going to be this candle. So these two green candles are going to be your leg out. If I'm going to put the proximal on a candle, I'm going to put the proximal on the first indecisive candle that then follows the leg out. So that's the first indecisive candle. That's the second indecisive candle. That's the third indecisive candle. I know that this is the highest body of the basing candles. However, just from experience, I'm going to put my proximal on the first indecisive candle following the leg out. Okay, so that will allow me to pinpoint the potential origin of that leg out. Because if you ask about proximal and distal and demand zones, then what we're trying to do here is we're trying to find the origin of that imbalance. Well, if I put my entry here, then I would say that the origin of this imbalance is somewhere in the middle of this already green candle, right? Cannot be. This is just now follow through. The origin has to be within the beginning somewhere of these green candles. And so I'm just going to use the first indecisive candles following the large move, which then, if you follow that, which is kind of my personal rule, if you follow that, you will see your proximal right at the 33,000 point mark, and then a distal right down there. And the beautiful thing here is that already, because I've done the work, right? I've put the 34,000 marker, I put the 32,500,000 marker. I know that I'm within the window of opportunity within location. However, I know I'm within the window of opportunity, but do I have the big brother coverage? Do I have the big brother coverage in terms of, am I not just within the right window of opportunity? Am I also within the very low on my higher time frames? Now, to check this, I just need to quickly cross-check against the higher time frame. And I've got the higher time frame here. So to cross-check price 33,000, look, my weekly demand starts at 33,412. 33,412 would be here somewhere. So I'm not just within the window of opportunity, I also have big brother, small brother coverage. So that's amazing, perfect. And in terms of the leg out, now I have found a zone that already meets the rules, right? So now what I have to do is, well, before I now go into the departure rule here, the zone qualifier, all these rules that we covered, okay, those were from prior lessons as well. What I want to cover is now our fundamentals. Do they speak the same language? Well, we've got our valuation. We're going into the lower 50 percentile, which we haven't been for quite some time, right? So on the Dow, we had been undervalued here. This produced a major rally. Then we had been overvalued here. Then from here, this produced a decline. And now we're in the lower 50 percentile, but we're not undervalued just yet. So it doesn't mean that if price is going to go down there, we're not going to get undervalued. As you can see, even with a rally in price, we can go further down, right? It just depends on what's happening in the treasury market here. But if we get undervalued, even better, right? This is a clear shot for us to buy, especially the lower we go here, the better. If we touch the green line at any point in time, right? So if, for example, we don't know if that's a zone yet that meets all the rules, but let's say it was, if price was going to come down here and we're undervalued with that context of the higher time frame technicals, then hold your heads. That's going to be a beautiful long to the upside. So fundamentals, at least we're not overvalued, right? Which would be the complete opposite of what we want to do. We're within the lower 50 percentile range, not ideally undervalued, but we may get there. We may get there. So that's good. We're rather neutral, rather more undervalued than neutral. So below the neutral line. And our seasonality now in terms of the when. So here we're saying, what are we expecting? Well, we're expecting to be more bullish than bearish, but we could be neutral, right? So what we see here in terms of the trend structure and the location would overrule this because we're just neutral. We can't say bullish or bearish, even though we can say we're slightly more bullish than bearish. And in terms of the true seasonals, we would say, well, where are we now? Well, we're expecting a big move. And the next big move is going to come on the 29th of June. So the end of July, ideally, is the best buy point. So now I've got my when, I've got my what, and I've got my where in terms of price that's aligned within the higher time frame technicals. So this is all we need to do, right? That's our job done. Now, if we go into our blueprint cheat sheet, then we've talked about the Dow Jones before. We look at the valuation. Do we care about the commitment of traders report? Well, we could, right? We could, but it's an infinite market. What matters more is interest rates. And then we're going to look at true seasonality. We're going to look at supply and demand. And then that's it, right? And so this is our blueprint cheat sheet. All these steps we've done so far. Now it's just all about placing entries, placing stops, placing targets, trying to get into this trade. So our first rule that we introduced is our departure rule. Now our departure rule, we look at the leg out, and the leg out has to be made up of explosive candle and or decisive candles that are abnormally bigger. In this case, rule 1, departure, yes, it's explosive. So it could just be as simple as, yes, it's met, right? So our rule 1, yes, it's explosive. And before, you could see before I'm even checking whether that move is explosive or not, I've done my homework in terms of the location. I understand where is weekly demand. I understand how much space I have until I approach potentially the opposing supply. I know what the trend is. It's an uptrend. If it's not an uptrend, then I'm anticipating an uptrend. So on direction, I want to be bullish. On location, I want to be bullish because I'm low. And in terms of my fundamentals, what do I expect? I can be neutral, rather bullish than neutral. We have to reevaluate as price potentially comes back into the zone. But at the moment, this is clear for a long. And when is the best time? The end of the month. Okay, by the end of the month, I for sure want to buy this. Okay, I for sure want to buy this. Okay, so if now all the other rules are also going to be met here, right? So before I even checked rule 1, I made sure that I've done my homework. Everything is aligned. I know the when, I know the what, and I know the higher time frame technicals. So first rule done. Now let's go into the second rule, which is base duration. Now from the get-go, I do want to mention that base duration is less important than departure, okay? And that's simply because when we look at the base duration, we look at how many candles are within that base, okay? And the argument is that in general, the more candles you find within that base, the more time these institutions had to fill their orders, and thereby the less likelihood of unfilled orders there is within a base that has a lot of candles, okay? That's the theory behind it. So the less time spent in the basing candles, the better. However, this also depends a lot on what's the time frame that you're looking at. If this 3 candles versus 1 candle, this could be a 60-minute chart, and this could be a 180-minute chart, a 3-hour chart, right? And so what I see within a 3-hour chart is what I also could see within a 60-minute chart, just different. And then I would say, well, this is better than this. Can't really say that, right? So, however, if we go apples to apples, we compare the same time frame, then we could argue that less is better than more. Okay, so if we have a lot of candles in the base, most of the time it's not a quality base. However, if all the other rules are in your favor, then this is not a criteria that should exclude a zone from your trade watch list. Okay, this can be an exclusion criteria, however, only if there's multiple rules that on top of that don't stack up. Okay, so if that's the only one isolated, I don't care if it's 5 or 6 or 7 or 8 or 9 or 10, because even if I have 10 daily candles, I may have, or even if I have, let's make it easier, 5 daily candles, well, I could make it 10 daily candles, then I have 2 weekly candles. So I have a powerful weekly demand or supply, so there must be powerful daily demand or supply there as well. So in theory, this makes sense. However, as we go into really the real world of charting, looking at this isolated doesn't make sense, but it can be a criteria that you use to exclude a level from your list of levels, especially if you had multiple levels on top of one another. You had one with, let's say, 10 candles, and then below that you have a level with 1 candle that looks a lot better than the one above. Then you know, okay, one may still be acceptable, but the other is at least better. So you would take just the better one. So you argue not just to qualify, but you also argue the quality and which one would be better. So that's why you always have a grade and an acceptable and a not acceptable for you to see as well. If you have multiple levels, eventually, if you see 1 versus 3 and you need to make a decision, and that's the only thing that's left for you to decide on which one you're going to take, be my guest and take this one, right? And just be objective about it. However, just if you have just one zone and you have one zone either with 1 or 3, they're both good to go, right? There's not going to be it's not going to be an issue. So we can make this lesson here, the base duration, very easy. What we're doing is we're looking at the basing candles before we looked at the leg out, and we're just counting the basing candles. And we're asking how much time did price spent in the zone. And to test that, we're going to count. We're going to count up to 6, and anything above 6 is when you have to pay attention. You have to check, well, is that really a quality demand or supply, or is there something maybe below or above that demand or supply zone respectively? And generally speaking, we can say that apples to apples, less time spent in the basing candles, the more likely we find unfilled orders. We can say that because the less time price spends, the less time also these institutions have to fill their orders. Okay. So we can say that, but as it comes to different candle time frames, you know, if you have a monthly demand that's quality, and then you have a daily demand in there that consists of 10 candles, then hey, you know, so be it. I mean, I'm in monthly demand, right? And monthly demand just has to be powerful. And so again, we are on lower time frames. We want to be scientific, but we don't take those lower time frame rules and isolate them and put them over and above everything else that we do in the beginning of our analysis, which holds a lot more weight. Okay, so you have to think about the modules that we're doing. Module 1, 2, 3, they hold a lot of weight, hence we do them in the beginning, because this is what we need to get right. We just need to get it right. We need to get the higher time frame location right, we need to get the direction right, and we need to get the fundamentals right. If we get that right, we go to market timing, then we're going to be wrong regardless of how we time the market. I can show you beautiful demand zones that got taken out by price, and I can show you ugly demand zones that held beautifully. So we're going to do everything we can to increase our probability in doing the higher time frame and fundamental work, and we're going to do everything we can to increase our profitability here in what we're doing. Okay, so I can tell you that a great versus an acceptable holds more probability, but if you can refine it within one candle, then most of the time it holds more profitability. Okay, so rather than from a probability perspective, we are looking at this from an angle of a profitability perspective. And hence, if I have a large move, then I know that my profit margin potentially is also going to be a lot higher if price comes back, right? And so again, it's all about the risk to reward here rather than, okay, how can I increase further my probability? Because our probability is increased by all these steps that we've done before even going to that. But now if we look at our rule 2, which is base, if I'm going to take 1, 2, or 3, regardless of which one I'm taking, I would say, yes, that's in line. It's between 1 and 6. So this is also met perfect. So now we can move on. We don't spend a lot of more time here on base. And what we do need to cover is that there may be potential speed bumps. Now, potential speed bumps is something that we may want to do a separate example on when we see one, but speed bumps are essentially fake supply and demand levels. Okay, they are fake zones. They're fake zones because they may trick you into going long or into shorting, but they're not real zones. They're just speed bumps. And usually what happens with those speed bumps is they are the same color than the existing move. So if within an up move, we see just one candle in the base that may be indecisive, but has a rather large body and that has the same color, it's just a continuation of that move, right? The origin is still down there. So just because we get some wicks that may fake us into or trick us into seeing this as an indecisive candle and into demand, it's not the origin. Okay, the origin is most likely lower if it has the same color and if the body is relatively large compared to the wicks. Okay, and this is also where, completely opposite to the basing idea, it just needs to be one, right? And one can also be bad sometimes. So if this looked like I had one candle here and then another candle here, if I had two candles, it would be a lot better than just having one candle where the body is rather large. So, so speed bump is something that is kind of vague at the moment for you because you haven't seen this play out in the actual trading arena yet. So let's just note it down that there are things like a speed bump. And then when we see one, we're gonna speak about it in more detail. So Bash, you're saying, so you saw a supply zone with 3 basing candles on the 240 minute. Would you be better to trade the 800 minute, for example, to shrink those basing candles into a single basing candles and trade that time frame? Could be, yeah. If you saw the same thing or a similar thing within an 800 minute time frame, that's even better, because the higher the time frame you see it, the better, right? And so if you see something high quality on the daily, you don't have to go into a 240. If you see something that already works on the 240, you don't have to go down into a 60. So how it works is you're gonna work your way up from the highest lower time frame demand zone you can look at. So an 800 minute demand zone, if that's something you want to look at, then that would be something that you check if you don't find something in the daily, right? So let's say I don't find something in the daily here. Let's say I did not find this zone. Then what I have to do is, well, I have to go lower. Maybe I'll find something on the lower. But there are a lot of time frames that I could look at before I reach a 240 minute time frame. So there's going to be 960 that I could look at. And then, of course, my indicators are now going to get scrambled. And of course, look, on the 960 even, I see something similar. It doesn't look the same, but I see a drop base rally. So I also see a demand zone here on the 960, just as I see on the daily, and it looks different. So the next step would be, well, if this is not something that you see, you could say, well, what about a 720 minute? Okay, this looks now kind of nice, right? We have a big, large move out. So here I could say even, well, I could refine this and go lower. I could even go as low as here, because this is where the leg out starts. Now I could go into a 600 minute. So you can see the area that we're looking at is always going to be similar. However, it's going to look different. Now on a 600 minute, I would see already here a rally-based rally. Okay. Now that rally-based rally is not something that I saw on the daily, right? It's not something that I saw on the daily. Does that mean that price is gonna react from this, or does it mean that price is gonna go actually into the daily and go higher? Well, I don't know, right? We don't know. If I only knew, that would be amazing. But in terms of probability, it's more likely for price to react from a daily demand zone than it is from a 240 minute demand zone. So if I find something on a daily, as a process, you want to write that down. If you find something on a daily, we're going through the steps. If this meets your rules and you're happy with your risk to reward proposition, don't go lower, right? You don't need to go lower. Save yourself time. The daily will be your best trade-off between probability of getting into the trade and risk to reward. Because if you go lower into a 240, you may find something that's down here. Yes, it's going to give you a better risk to reward, but it's going to give you less probability of actually being filled, because price will have to go a lot lower to fill you versus here, it just has to go here. So daily, most of the time, should be your bread and butter. You have the best trade-off, best yin and yang between probability of getting filled and then also a good risk to reward position. If you, of course, now put your daily here on these three, on the top of these three indecisive candles, now as we speak about the base, right, it's kind of, okay, as we speak about the base, then let's also speak about where we put our proximal within the base, because we put it on the preferred version of the highest basing candles of the highest basing candles. However, already what we did is you used my personal rule, which is use the first indecisive candle following the leg out, following here in this case the green candles. So already you refined this quite a bit, because if you had it here, then we would have to go lower in terms of a time frame. Then you would say, well, okay, let me check a 240-minute demand zone to then see, okay, how can I find something down here that is lower than here, to just refine the entry overall. But without overcomplicating it in the beginning, if you just use those two rules, daily on the base, use the daily, and then put your proximal on the highest base of the first indecisive candle, you're going to be golden. If you would further refine it, you could even refine it on the daily, and you could go into the wick area of your basing candles and or leg out, right? Because oftentimes price goes into the base, yes, but also into the wick area. So if this is, for example, too big, you could still stay on the daily and say, well, I'm just pulling this down to the wick. And then if you were to go down into a 120-minute or 60-minute, for sure you would find something down there where you would then find, probably on a lower time frame, somewhat of a level of demand, right? So right here now on the 60, you have that perfect drop base rally. That's that first demand, and then the next demand is kind of rally based rally here. But this is the demand that probably pinpointed you would want to look at if you were to refine, right? And all I did is, rather than doing the work on a daily, I just put my proximal to the lowest body right here. And however, I don't want to be a pig, right? I would still want to have some probability of getting filled. So I'm just going to put it here and then test it like that. And later on, we anyways have level on top of level set of rules that may anyways widen the zone, or we look below that even. But so far, so good. We covered two rules. They're very straightforward. On the base, there are some advanced things like my personal rule that you could write down, as well as the speed bump rule, which this cannot be a speed bump because we have more than one candle in the base and it's a different color. And it's really a base, right? It's not just a fake base, if you will. Let's see. Let's cover one more rule potentially for today. Yes, Jan, it's nice on the 60-minute. You would take the previous low for extra coverage. Yes, yes, right. This is definitely something that you can do. Even entry at the 33,000 mark and then stop loss below. But what you're saying is probably already a bit too jumping the gun in terms of, okay, why, in terms of stop loss, we haven't talked about yet. So just in terms of entry, our proximal is going to be our entry that we know. And in terms of stop loss, we're going to have to talk about it. So far, we just know that our stop loss is somewhere below that zone. But we have to check on more of our rules to finalize our stop loss, if you will. So far, we just looked at the structure of the zone, which is now completed. We check the departure, check. We check the base, check. So now we move on to freshness. Okay, so freshness is a term that should be familiar to you guys. We use it on the higher time frame as well. And the difference between freshness on the lower time frame versus the higher time frame is that what you see right here, a test, a first touch of the wider area, is only maybe acceptable. Okay. While on the higher time frame, a wider is definitely acceptable, right? Because we have the 25% of the preferred on the higher time frame, and here we are looking at the wider, and ideally we have no test at all. So we are completely fresh on the wider, and we don't even have a test here on the lower time frame. What is not acceptable is multiple tests or a test within the preferred version, because that just means that a lot of orders have been filled already, and it is likely that the next time price comes up, we're going to shoot through the zone. So the laws of price and order flow would play a role here when we look at the freshness per se. So here are your rules on that. And you can see I'm kind of jumping over the slides just because, when I go into the practical application, just want to spend more time in the charts than in the slides. So kind of jumping over those slides, doing it quickly, and then spend more time in the charts, which is, I think, the right way to go about it. So, but you guys can, of course, always slow me down or ask questions like you do anyways. So here are your rule cards. So again, we have a higher time frame and a lower time frame rule. The higher time frame rule is it can be tested 25% of the preferred version. So we're testing the preferred, and it can even be tested by 25%. Now, though, if I go into the lower time frame, just as we did with departure, as we looked at explosive versus decisive, here we're going to look at preferred versus wider. So the test that we're performing is a lot stricter. It has to be stricter because we're on the lower time frame. We have to become more of scientists and really look at our zones. And so there's going to be a beginners and an advanced rule. For the beginners in this room, you can just be black and white and say, if the wider is tested, it's done and dusted, you walk away. The advanced rule is if all rules are met and you just have a wider test, then you can still take it. Okay. But again, we're not isolating this. We're putting it into the right context of everything else, which is then the advanced way of doing it. So of course, a fresh zone implies more unfilled orders. The less touches, the better. That is true. There's no two opinions about it, and that will stay true. So here, if I see that leg out here, has price ever been back, or has price ever tested this demand? No, it has never tested that demand. There's never been there. So if we saw something like this, right, then this would be tested for sure. Now, this is not the wider version, right? This is the preferred version. And this is even my personal rule on the preferred version. So the wider version, your wider version is either going to be here or it's going to be here, right? On either this or this here. So this is now your preferred version, your wider version. So now your test is different, right? You're not testing for a price to be here, but you're testing for price to be here. So let's argue price comes in and then it goes out, and now price comes back in. The question is, would you still take this trade? Well, we could if we're within that. Yes. Yes. And our fundamentals. Yes. So the advanced rule is, so therefore the advanced rule is here it's still okay because everything else is meeting my rules. However, if you have that same scenario and now all of a sudden here you have a no, here you have a no, then here you're also going to have a no. Anyways, potentially you're going to have a no. So you're going to have a no if it's already tested on the wider. So in the beginning, you can make it simple. If this happens, just walk away, right? Walk away. This is basically the second test, but you will see us doing this often, that we will take the trade, even though it may seem like it's tested. And that's where the conversation around freshness is kind of vague as well. It's kind of abstract. I think the best way for you to look at freshness, and this is something that I also realized it's maybe a better way of explaining it, is if price is going here and then it's making the move that I was expecting it to do, and then it's coming back into the zone, then I'm not going to take that trade no more, right? However, scenario 2 is price is going down, it's testing on the wider, it's going up a bit, but it's anyways not doing the move that I would expect it to do, right? Because I'm expecting this move, which has not yet happened. Price is still meandering about. So, and you would say now this is tested. Well, I'm still expecting a major move out of the zone with the setup that I have. So if then price comes back, I'm still taking that trade, right? Because I am expecting price, I am expecting a major move. And just because price is meandering about doesn't mean that it's tested. It means it's filling orders, it's in the zone, right? But my entry may be low, so price may be meandering about before it goes and it fills me. And so this is very much still fine because I'm expecting that move. However, if that move already happens before it comes into the zone, then it's a no-go. Okay, so different way of looking at it rather than just black and white, has price been there or not. Also checking more of the advanced way. Has price done what I would have expected price to do? If so, it's done and dusted. If not, you can still take it. So in this case, what can we conclude with our third rule? Well, there's no two opinions about this example. It's all fresh. Price has not been in the wider, price has not been in the preferred. price is still up here after the leg out. So so far so good, right? So if price is going to come back in, already we have these 3 rules alone. If we're going to add one, it will be later level on top of level. There will be more that we will look at, but the important ones, these 3 and level on top of level, aligned with the right context, you've got 99% of what needs to be done. Okay. So on top of this, we're going to do level on top of level. There's going to be other rules, but these other rules, they are going to be not so important. Okay. They're going to be not so important. So here, this is 99% with everything else. And then there may be 1% still that we're gonna be looking at. And I do want to conclude with this, because after this we go into originality, and with originality we have to take a bigger swing at this, right? We have to talk about more backdrop of what we're doing. So we talked about freshness is where we look to the right. Next time we're going to actually look to the left as well to see, hey, what's is that the origin? Or maybe there's some demand here that's a bit better because that's the origin. And then we're going to use that as a ways of further understanding and defining price and potentially refining our entries. But we're going to, as I said, start this next week because we have to take really a bigger swing at this. I will end the recording right here. Thanks for watching, and I'll catch you all next week. Feel free to stay around and ask questions. If not, thanks again. Happy and safe trading, and ciao.